All right, so we are jumping into first in, first out as our inventory cost flow assumption. And so again, we have average cost, FIFO, and LIFO. If you've hopefully gone through the average cost lectures, this is going to be way easier. But we do have some things to keep track of. And so again, the idea here is if we think about that stack of inventory, August 1st all the way through August 24th, as far as our purchases. Under FIFO, we're going to assume that the oldest ones, or the ones from August 1st, are going to be sold first, and then we'll kind of work our way down to August 5th and on and so forth. And so the way this works again is that the first ones in are assumed to be the first ones out. And the way I always think about this typically is sort of like if you go to a grocery store and you're going to the dairy section, you're going to buy milk. And so you kind of look in there and you try to find, okay, where's the newest milk? Well, the newest milk's going to be in the back because essentially, if you kind of think about that chute, they're stuffing and then it goes out there. So it stuffs and then it goes out, stuffs and goes out. So basically, imagine it's almost like a funnel where the first things that you're going in by assumption are going to be the first things that go out. And so when we think about our ending inventory, then the newest items are going to be in our ending inventory, and the oldest items we're going to assume have been sold. Now, again, the actual physical flow might be different than that, but what we're saying is when we're not tracking item by item, this is the assumption that we're making. All right, so again, same table, same purchases, everything's the same, but now we're just doing a periodic FIFO example. So again, periodic means we're not touching the inventory account, we're not recording cost of goods sold or anything else until the very end of the period. So essentially, we have all of this information, and then from there, we're going to calculate our cost of goods sold and our ending inventory for the month of August. All right, so if we again we kind of think through this, part of what we have to think through is, theoretically, I want us to kind of think in terms of the sort of how we should approach this. If you remember a couple lectures ago, I said that the balance sheet should drive the income statement. And so the same thing is true here. In other words, the right theoretical approach here would be we calculate our ending inventory, and from that we derive our cost of goods sold. And if you remember when we did our adjusting entries with the periodic system, we had the beginning inventory, we had the ending inventory, we had our purchases, and we would derive cost of goods sold. Well, the reality is we needed the ending inventory number in order to derive cost of goods sold. And so we're kind of taking that same approach here in that we're going to calculate ending inventory, and then from there, we're going to calculate cost of goods sold, or we're going to derive cost of goods sold. And so thinking about it again, whenever we do these problems, if you want to kind of think through it, hit pause and then pick it up. But I'm going to kind of just walk through as an explanation. And so as far as the inventory, again, we're starting with our ending inventory, which means that we're going to assume that the August 24th inventory is still in our ending inventory. In other words, that's going to be the last stuff that we sell. And so we're going to assume that's in our ending inventory. So remember from our average cost example, and we can do the math here again if we want, the number of units in ending inventory is the number of units available for sale minus the ones that we actually did sell, which means there's 2,340 units available. All right. And so to get to 2,340 units in our ending inventory. So for us to get to that number, not only do we need all of the units from August 24th, but we also need some units from August 13th. And so our ending inventory will have basically two layers. So we now have got an August 13th layer and we have an August 24th layer. All right, so again, those different layers. We know that the total number of units is 2,340. Again, 5,970 minus 3,630. We know that 1,000 or all of this first layer, so 1,865 units is going to come from August 24th. And the remaining units, 475, are going to come from the August 13th layer. And so then we calculate that. Of course, $10 a unit is the unit price for the August 24th. $9.80 is the unit price for the August 13th. We add those up and we get ending inventory of 23,303. So from there, we calculate our cost of goods sold. And again, theoretically, what we are doing is deriving cost of goods sold. And so the way we're going to do that if you kind of remember that journal entry, maybe we can kind of piece this together. But essentially, we had our beginning inventory and we had our purchases. So really, we have two different components here. And then from there, we kind of derive our cost of goods sold. And so another way to think about that is that our cost of goods sold is the sum of our beginning inventory and all of our purchases minus what we just calculated as our ending inventory. It essentially becomes that plug in the journal entry that we did several lectures ago. So again, very straightforward calculation. So we have cost of goods available for sale. We've calculated our ending inventory. Therefore, our cost of goods sold is $34,349. And so if we kind of just sort of fast forward then, our ending inventory in August is going to be our beginning inventory for September 25th. And so we're going to have two layers starting at the month of September. And under the FIFO inventory cost flow assumption, we're going to assume that the August 13th ones are sold first, then the August 24th ones are sold next. And of course, during September, there's going to be additional purchases as well. So you're going to kind of have a new table and new sales. But when it comes to what's sold, the August 13th and August 24th units likely are going to have been sold in the month of September. But there are starting units for the next month. All right, so now we're going to do the perpetual FIFO example. Again, perpetual means that we're calculating cost of goods sold with every single transaction, and we're just sort of updating our information. So it's going to be a slightly different approach in terms of the timing. And again, so we need a cost of goods sold number, so we've got to calculate that in order to do the cost of goods sold journal entry whenever there is a sale. Of course, at the beginning of the month, all we have is our August 1st beginning inventory, no change there. And then, of course, there is that purchase on August 5th. So now we have two layers going into from August 5th on. And of course, now we have that purchase coming up. But again, two layers, total cost is going to be sitting there at $27,930. So again, we're just kind of looking at the different layers, and the math is in the table and it's right here. So we're just sort of seeing it two different ways. Where it starts to become important now is with the sale. So again, with the first in, first out inventory cost assumption or cost flow assumption, we believe, or we're going to assume that the August 1st items are sold first. And so if we have 1,420 items that are being sold, they can all come out of our August 1st layer. And so again, those are the two layers that are there at the time, and everything's going to come out of our August 1st layer. And so our cost of goods sold on August 7th is those 1,420 units times $9.30 for a total of $13,206. Of course, we do have inventory that we're carrying forward. There's some units from August 1st and all the units from August 5th. And so we would kind of update our table at that point in time with the new number of units for August 1st. Of course, the new total cost, $14,724. This isn't being reported anywhere. We're just tracking it. All right, so another purchase, hopefully fairly straightforward. We're adding another layer. No real math here, just adding a layer into our table. And now with this sale, again, there's 960 units that are being sold. And again, with FIFO, we're assuming that the oldest units are being sold first. So these 680 units will all be sold, and then everything else must come out of the August 5th inventory layer. And so doing that math real quick, we have our, again, starting at August 1st, those 680 units go out the door. That layer is gone. The remaining, I think it's 380 units. 280 units. That comes from our August 5th layer. And so together, the cost of goods sold for that sale is $9,012. Again, that's what we would record in our journal entry as part of our sale. All right, so again, we're updating instead of kind of go back and forth here. Instead of 875 units, we're down to 595 units, or 1,725 units total. And so that's the balance, 595, another 1130, and the total cost, $16,786. Again, that's the sum of the two layers. All right, we add an additional layer, August 24th layer, pretty straightforward. And then from there, Again, we have another sale, the 1,250. Again, we're working our way down. And so from there, we're going to start with our August 5th layer. All those are going to be used. And the remaining units are going to come out of our August 13th layer. So out of that 1,130, we've got another 655 units that we're pulling out of that. So a total cost of goods sold, $12,131. And then finally, of course, our inventory balance, if we're going to do this update real quick, we're not going to have 1,130. Instead, we only have 475 units at $9.80. And of course, all the units from August 24th still remain. And so our ending balance in our inventory is 23,305. Again, this is the perpetual FIFO example. All right, so our cost of goods sold, we sum up the three different entries that we did for cost of goods sold. So the August 7th, August 19th, and August 27th cost of goods sold calculations, we're just summing them up. And of course, we just calculated our ending inventory. And one thing we should note here is that this is the exact same. In other words, there is no change in our cost of goods sold and ending inventory when we're using FIFO. So whether we're using the perpetual inventory system or the periodic, we end up with the same thing. And hopefully that kind of makes sense. I mean, going back to Harris Teeter, I mean, if we're always taking, if the buyer is always taking from the front, it really doesn't matter when those things are loaded. If you kind of think about it, if they're in the periodic system, what we're assuming is the buyer comes along at the very end of the month and just takes everything, all of those sales, the 3,630, they take them all out at the end of the month, whatever is left. That's no different than if they were taking it out a little bit at a time. They're still taking the same units at the end of the day. And so the ending inventory is going to be the same. If the ending inventory is the same, then the cost of goods sold is going to be the same, but only under the FIFO cost flow assumption. All the other assumptions, the numbers are different. And again, similar to the periodic, those layers that we have on the perpetual system, those are the same layers that are going to go forward and start the next month. And of course, there'd be additional layers from there. All right. Well, hopefully that's helpful, and we'll stop there. We'll do another lecture for LIFO, and we'll kind of keep cruising.